It's time now for an in-depth look at the global markets as we start the week. And for that, I'm joined on the line by Dr. Hwang Sei-woon, Research Fellow at the Korea Capital Market Institute. Dr. Hwang, thank you for coming on today.
Good to be here with you today.
Well, global stocks in recent days have been gaining, but we're still seeing signs of weakness ahead for a few reasons. Korean stocks, though, up today. What's the story?
In Wall Street, the stocks finished the week mixed on Friday as Treasury yields jumped to 6-week highs and the dollar slipped. All major U.S. indices still closed higher for a third consecutive week after being whipsawed by a rotation from growth to value shares by some investors. Optimism over a trade deal is growing ahead of expected high-level talks next month between the U.S. and China. With holiday spending on the horizon and inflation at bay, stock markets could continue to see momentum in the retail sector. Oil surged along with the yen and Treasury futures after a strike on the heart of Saudi Arabia's oil production increased geopolitical risk concerns. Sentiment for risk that's gathered steam in recent weeks is being tested after the weekend's developments in the Middle East. U.S. equity futures declined, while shares in Asia were mostly lowered. Shares in Hong Kong underperformed after China data missed estimates, while equity rose in South Korea by 0.64% today.
Well, as you mentioned, the big story today is the jump in oil prices after the attack in Saudi Arabia. Where do you see oil prices going from here?
Oil prices retreated on Monday after hitting their highest since May at the open. On fears over supply disruptions following an attack on Saudi Arabia's oil facilities on Saturday that cut more than 5% of global oil supply. Prices eased off their peaks after U.S. President Donald Trump said he approved the release of oil from the U.S. Strategic Petroleum Reserve if needed in a quantity to be determined due to the attack on Saudi Arabia's facilities. Saudi Arabia's oil exports are expected to continue as normal this week as the kingdom taps into stocks from its large storage facilities. The surge in prices is the natural reaction, but the path ahead and ability to sustain at elevated levels remains dependent on the duration of the outage, the ability to meet export commitment through domestic drawdowns, demand elasticity at higher prices, as well as government and agency policy. The risk premium in the global crude market is expected to rise for a while, which may increase market volatility in crude oil trading.
Yeah, we'll see how long this lasts. But now, looking ahead this week, we have the Korea Exchange going paperless. All the stocks and bonds will be digital. And we also have the latest greenbook coming out from the Finance Ministry. What should we be watching?
South Korea introduced an electronic securities system today, under which all listed stocks and bonds do not exist in paper form. Under the new system, securities certificates of listed stocks and bonds are required to be recorded on an electronic register. The introduction of an electronic securities system is expected to save costs of issuing securities, reduce risks in securities circulation, and enhance transparency in corporate governance and securities transactions. In the United States, the Federal Open Market Committee will issue its policy statement on Wednesday, which could be the central bank's second rate cut after lowering rates in July for the first time since year 2008. Markets are pricing in a nearly 90% probability that the Fed will shave another quarter point from its current overnight lending rate of 2.2 to 2.25%. The Bank of Japan meets on Thursday for its benchmark rate decision. The pressure from markets to add to its stimulus has weakened as investors take a less gloomy view of the economic outlook and the trade war. That leaves most economists expecting the Bank of Japan to keep policy on hold as it conserves its ammunition.
All right, Dr. Hwang, we'll be watching all of that this week. Thank you for your time today.
Thank you very much.